What a year! Let's see how much I made. Wow! I made a solid profit and there's money in my bank account. Time to reward myself.
Alex just wrapped up a great year freelancing. But then, an unexpected letter lands in their mailbox. It's from the tax office. You owe €27,000 in taxes. Please file your tax return.
Wait, what?
Income tax is the money you pay to the government on your profits. Not your total revenue, your profit after deducting business expenses. Think of it as a tax P&L. It's P&L that follows the rules set up by the tax office. Main difference with your accounting P&L is non-deductible expenses. Profit under tax P&L is called taxable profit, and to calculate income tax you apply tax rate to the taxable profit. Only business-related costs reduce your taxable income. These are called deductible expenses. Think tools, travel for client work, and professional services. But not everything you spend as a freelancer counts. Personal expenses, like lattes, sneakers, are non-deductible. Why? Because tax authorities generally don't see those costs as directly related to earning business income. In other words, they don't help generate your revenue, so you can't deduct them. Tax laws vary, so always check the rules in your country to see which expenses are deductible and which aren't for income tax purposes.
I have to return some of my purchases.
Let's talk about VAT, short for value-added tax. To understand how it works, let's follow the journey of a simple apple, from the tree all the way to a bottle of apple juice in a customer's hands. Along the way, we'll see how VAT is added at each step. Step 1. A farmer sells apples for €10. They add €1 in VAT, so the invoice total is €11. The buyer pays €11, and the farmer sends €1 to the tax office. Step 2. A transport company buys the apples for €10 plus €1 in VAT. They then sell the apples to a wholesaler for €15 and add €1.50 in VAT. The wholesaler pays €16.50, but the transport company only owes the government the difference, 50 cents. That's the difference between €1.50 of VAT they collected and €1 of VAT they already paid. Step 3. The wholesaler sells to a retailer for €25, adds €2.50 in VAT. The retailer pays €27.50. The wholesaler sends €1 in VAT to the tax office. That's the difference between the €2.50 they collected and the €1.50 they already paid. Step 4. The retailer sells to the final customer for €40 and charges €4 in VAT. The customer pays €44. The retailer sends €1.50 in VAT to the tax office. That's the difference between the €4 they collected and the €2.50 they already paid. Now, here's the magic of VAT. Each business only pays tax on the value they added. But the government still gets the full €4. So VAT stands for value-added tax because it's collected in steps, from farm to shelf. In some countries, VAT is called sales tax or goods and services tax, but the idea is similar. It's a tax added to the price of your services or products. Now here's the catch. You usually only need to register for VAT when your turnover, that means your total sales revenue, goes over a certain threshold. That number depends on your country, so always check your local tax rules. And once you're registered, you'll need to file VAT returns regularly and keep proper records of all your sales and purchases. And remember, VAT isn't your money. You're collecting it from your clients and passing it to the government.
Looks like I need to register for VAT, as my sales turnover is above the threshold. Okay, time to calculate my VAT. My total sales this year were €150,000, so that's my turnover. I also had €70,000 in business purchases. That leaves me with €80,000 net. Now for the VAT, I charge €15,000 in VAT to my clients, that's my output VAT. And I paid €7,000 in VAT on my own business expenses, that's input VAT. So, I subtract the input from the output, €15,000 minus €7,000. That means I owe the tax office €8,000 in VAT.
To stay on top of your taxes, track your income, expenses, and invoices regularly. Keep receipts, whether digital or paper, and make sure to separate business and personal spending. And no, a goat ate my accounts, or pirate stole my receipts, won't fly with the tax office.
Most tax authorities require you to keep your records for several years, usually around 5, but it depends on your country's statute of limitations. So, don't toss those documents too soon. Taxes can feel intimidating, but they don't have to be. Learn the basics, keep good records, and if you're unsure, ask a professional. And watch out for the common mistakes many new freelancers make. Guessing instead of tracking. Losing receipts. Mixing personal and business expenses. Forgetting to save for tax. In the next episode, we'll show how to interpret the numbers using simple ratios, to see how profitable, efficient, or financially healthy your business really is.